This bill could change where you go to school, how much debt you take on, and whether you qualify for loan forgiveness. And the worst part, it's already law. If I look tired, it's because I've been up all night reading the 900 pages of this new student loan legislation and helping clients prepare. This law, nicknamed One Big Beautiful Bill, just reshaped student loans as we know it. And whether you're in undergrad, medical school, residency, or already practicing, this impacts you. So let's break down what's changing, what's staying, and what I do if I were in your shoes at each stage of a medical career. Now, first, let's talk about what happened. Congress passed a sweeping education bill that eliminates most current repayment plans. Save, pay as you earn, and income contingent repayment plan will all be gone by 2028. IBR survives for now. Thanks to Congress. And a new plan called RAP, or Repayment Assistance Plan, becomes the default for new borrowers starting July 1st, 2026. Some of the scariest proposals were struck down by the Senate parliamentarian, thank you, but this bill still changes how we manage loans, how we qualify for forgiveness, and what repayment will cost. If I were in your shoes, I'd be considering my options. And if you keep watching until the end, I will tell you exactly what I would consider and my logic behind it. Now, what exactly is RAP? It is the new income driven repayment plan. And if you are a high income earner, then you likely will be charged 10% of your income. And that is adjusted gross income, not your discretionary income like all the other income driven repayment options were based upon. It also has a 30-year forgiveness timeline. They have made student loans like a mortgage, like you start your career and you end your career paying student loans. One of the things is that there is no cap on payments. So as your income grows as a high income earner, your payments will also grow. And one of the good things about this RAP plan, because it's not all bad, is if your payments don't cover the interest, RAP offers forgiveness of unpaid interest. And if your principal amount does not reduce by $50 a month with your payment, you will receive a $50 credit that will be applied to your principal. It also gives you a $50 deduction per child per month. But it's not as generous as the income-based repayment for household size adjustment. So for most physicians, RAP will keep you in debt longer and results in higher total payments. If you have Parent Plus loans, you have until July 1st, 2026 to consolidate and access the income-based repayment option. Now, this is tremendous because before you could only access the income contingent repayment option, which was based on 20% of your income if you did this whole double consolidation maneuver. Now they're allowing access to the income based repayment plan, which could be 10% to 15%, depending on when you borrowed that loan. But if you miss that window, if you miss the July 1st, 2026 deadline, you will automatically be moved into RAP. So if you borrowed before July 2014, you'll be in the old income-based repayment, which is 15% of your income and 25 years to forgiveness. If you borrowed after July 2014, you qualify for the new income-based repayment, which is 10% of your income and 20 years to forgiveness. In most cases, RAP is the worst option unless you are part of that Parent Plus loan borrowers, or if you're single, child-free, and not planning to pursue forgiveness. And while RAP and this one big beautiful bill changes the game for student loan borrowers, I want to highlight here that RAP is not a bad option for those who have a small family size and not looking for forgiveness under public service loan forgiveness because of its negative amortization that prevents your loan from ballooning. So thinking about the amount of interest and the timeline for payoff versus forgiveness are major factors to consider. And speaking of timeline, here are some dates that you should know. On July 9th, an abrupt policy shift announcing that those in the SAVE forbearance will begin accruing interest on August 1st. So that means that the SAVE plan forbearance will no longer be interest free, putting 7.7 million borrowers in financial worry. So between 2026 and 2028, repayment plans like pay as you earn and save will disappear. So if you do nothing, you may be auto switched into RAP or IBR. Let me give you a word of encouragement. Act early. Don't let the system decide your repayment plan for you. Now, I'll tell you what I would do if I were in your shoes and which plan I would choose. If you are a medical student, you will likely be allowed to finish borrowing under your current promissory note. Grad Plus loans are going away in the future, but if you are currently enrolled, you likely will continue to have access to Grad Plus loans. But a word of caution here: borrow only what you need. This is not the time to upgrade your lifestyle, right? Skip that unnecessary travel, cut back on your spending, and avoid adding dual degrees that could trigger new borrowing rules and not really add value to your life, your career, or your wallet. I pursued a master's of public health while I was in medical school, but without grants, I'm not sure that I would take out private loans to do so. Medical school is also a great time for you to understand what you want: forgiveness, or if you want to pay off your student loans, and establish systems to track and plan your finances. You will need these skills as a resident when you start to actually pay on your loans under the income based repayment option or RAP. And if you are an intern or new resident, file your 2024 taxes as a medical student. That means that you will be reporting $0 of income to the IRS. And at that point, I want you to consolidate your loans immediately so that you can use your 2024 return as income verification. This locks in the $0 payments under income driven repayment, and it starts the clock on public service loan forgiveness. If you are a junior or senior resident or a fellow, I consider a few options here. The first is, what is my current adjusted gross income? If you don't know, you can locate this on line 11 of your 1040 form of your individual tax return. The second thing you want to consider is calculate your payment under your current plan, whether that's pay as you earn or IBR, and what it would be under IBR or RAP. This is because you will be required to start to transition all plans into either IBR or RAP by 2028. But maybe you want to delay that timeline to 2028 if your payment will likely be lower under pay as you earn. And for many borrowers, when you think about it, if you're part of old IBR, even at that 15% of your discretionary income will likely be lower than the 10% of your adjusted gross income under the RAP plan. And third, if you're in a save forbearance and also hoping for forgiveness under PSLF or IDR, I would recommend switching into IBR now to have as many of those lower income payments count towards your forgiveness. Remember, the name of the game is paying the least amount over time. So you want to do that by capitalizing on your lower income before you become an attending. And if you are an earlier attending with 1 to 5 years, know that your save or pay as you earn plan may sunset by 2028. So if you're going for PSLF, you can move into the IBR plan, which is based on your discretionary income, especially because save will begin to accrue again during this forbearance period. Like residents, you will also need to evaluate your adjusted gross income and also your contributions to pre-tax accounts that help you to reduce your adjusted gross income. So these accounts include 401ks, 403bs, 457bs, HSAs, FSAs, dependent care FSAs, or limited FSAs. And if there's an opportunity to maximize them, this will reduce your payments on either income-driven repayment option. And just remember that FSAs are use it or lose it. So avoid overfunding those accounts. And if you are later in your career, say you're an attending and you have 6 months or less to forgiveness, move into IBR now and finish strong, because buyback likely won't process in time. There have been articles that stating a backlog. Although it has sped up the process recently, it likely will still take more than 6 months for your buyback to be processed. So don't wait. just cross the finish line strong. And if you're new to the whole idea of buyback, it's a one-time opportunity when you can retroactively receive PSLF credit for time spent working at a nonprofit. So even if you weren't in a qualifying repayment plan, this will allow you to buy back that time. Think of it as a forgiveness time machine. And for anyone who's working for an eligible employer, then you want to get that certification, whether you're a resident, new, old, attending, then go and get that certification just in case you want to buy back that time later. Now, I know that not every employer will qualify for public service loan forgiveness. So if you work in a private sector that does not qualify for public service loan forgiveness, but you still want forgiveness under the income driven repayment options, I would do this. Evaluate your payment under IBR versus RAP, optimize your AGI, contributing to pre-tax accounts. In most cases, unless you're single with no kids and you don't want kids, IBR is better. So IBR is better for those who have a family because it will give you forgiveness after 25 years instead of 30, and it gives you 150% times the federal poverty line for your family size. For example, a mother with adjusted gross income of $100,000 a year with 2 children would have her payments based on an income of $60,025 instead of the 100K because of the federal poverty line for a family size of 3. And paying 15% of $60,025 is about $9,000 a year, which is $750 per month. So that same mother making an adjusted gross income of $100,000 under RAP would have $100,000 minus a $50 per month subsidy for each of her children. So that would equate to $1,200 of a dependent deduction for that year. So her payments would be based on an income of $98,800 with a yearly student loan payment of $9,800 per year and $823 per month with forgiveness after 30 years or when that loan is paid off. So you can see the payment is going to be higher under RAP and she would have to pay for much longer. Now, I just want to put this out there. So just a word for those who live in a common property state. Common property states include places like California, Texas, Arizona, and others. And if you have student loans and you're married living in this common property state, then filing separately may not actually help you to separate your income from your partner's income. So the reason why is because in a common property state, basically it will take your income and split the income equally. Of course, you have to submit an IRS form 8958. And there are different ways to verify your income under these income-driven repayment plans if you live in one of these states. So for example, if your spouse earns less, then this might actually help you to lower your payment because when you file your taxes separately, you're effectively going to reduce your amount because your spouse earns less. So that means some of that higher income will be shifted to your spouse and they basically take an average. So the average is going to be less if you are the higher earner. So in that case, you want to submit your tax return with that 8958 documentation. But if you are the lower earner with loans, that will effectively shift income from your higher earning spouse and reflect that you have a higher income. Instead, what you want to do is provide an alternative income document like a recent pay stub or an employer letter that verifies that you actually earn less than what your income taxes show. And honestly, this is going to be for anyone who might return to school or take a lower paying job than the previous tax years. You want to submit some type of documentation that reflects that lower income so that you can have a lower payment. All right. So now you know what I would do, whether I'm an attending or a medical student, even those who are in undergrad, you kind of fall into that medical student bucket and you really want to conceptualize how much debt you're taking out, which schools you go to, choose public schools or the schools that are going to give you more scholarships so that you can reduce the amount that you take out. And while I think that the individual impact is important, there's a broader impact that I want to address here. The elimination of Grad Plus loans shields and new loan caps could reshape medical education access. There will be a cap of $200,000 for medical schools and also law schools, and $100,000 for other graduate schools. So many professional programs may shrink or close altogether. And this could limit access to medical careers for middle class and underrepresented students and reduce diversity in healthcare, let alone perpetuate the shortages that we're seeing for those who are going into primary care, those who are working in rural areas, and doing the boots on the ground work that is needed for those who don't come from a legacy of wealth. So, wherever you fall, here's what I recommend. Start to really conceptualize not only your student loan strategy, but how this impacts your career choice, how this impacts the longevity of the work that you do, and how this impacts the wealth building. Remember, managing student loan debt is just one of those factors that is required to build this longevity of wealth. And if you don't have a plan going into 2026, they will start to decide for you. So let's take action today and really think about how we want to structure not only our student loans, but how we want to structure our lives to create a life of freedom, a life of fulfillment, and a life of joy. Now, if you learned anything or if you have any questions, then put them in the comments, because I've been spending hours answering questions on my YouTube channel and also on Instagram. And I am here to help you. Now, I may not have all the answers because things are always changing, but let's figure this out together. And I just want to say thank you for being here. Subscribe to my channel, and I will see you on the next one. Bye-bye.